So today's session is going to be with our main guest, Charles Edwards, on how 22 crypto market would play out from his perspective. And we also have our talented on-chain analyst panels, including CryptoQuant CEO Kyung Ju, CQ Verified authors, Crypto Wizard and Spirit Chomber Kim, to have a discussion with Charles Edwards after he shares his view on 2022 crypto. Now you can carry on from here, Charles.
Sure. Thanks for the intro, guys. Sorry about the technical issues. Great to be here. I'm working through a cold, so you have to bear with me. I'm sorry. um, yeah, so 2022, I think it's definitely going to be an interesting one. Cycle-wise, I think this is if you're just looking at Bitcoin and crypto, this is a bear market. But I think there's a number of reasons for that, the impact of that to be diminished. And primarily, the impact of the cycles and the halvings is much more dampened now, I would say, and that's driven by institutional adoption. It's driven by diminished impact of miners, the reduced supply and control of new supply that they have. It's also driven by the market being much more bigger and efficient today. So we didn't have the blow off the tops that we saw in prior cycles. The relative extremities were much more diminished on the upside, and I think they'll be more diminished as well on the downside. And that is also furthered by the macro environment I think that we're in, and the drivers for institutional, country, and company adoption, which I think kind of moisten the lower base floor of the price through time. So, we used to see sort of 85% drops in prior bear markets. I think this cycle, I'd be surprised if we get anything that deep. Of course, there's always the outlier events which could trigger something. If there's a major macro TradFi meltdown, I think that will have have an equal or larger effect on crypto. But withstanding that or withholding that for now, I think the downside is a bit more constrained than it used to be. But likewise, so is the upside. The market is much more efficient, and we talked about this in our January newsletter on caprioli.com, talking about 2022 market, and a lot of on-chain metrics, a lot of even technical metrics. The extremities are much lower. That MVRV is one example where we just do not, over time, the highs and lows that you see on a number of these metrics has dropped with time. It's kind of funneled down to a lower level, which is just a sign of the market being more efficient and people being more aware of these metrics, counter trading them or using them for liquidity, and just this information being much more prevalent. Prior cycles, a lot of this stuff was done on Excel sheets. Only a few people were looking at them, whereas now they're everywhere. They're very public, and that is great, but it also means that unless a metric or a data point has a lot of, a really high hit rate, it's kind of less, so in some cases, less reliable because there's a lot of noise in there. So it's just I try to summarize the nature of the market participants, the data, and everything that's available today, and just being $1 trillion asset class. This Bitcoin, crypto, it moves very differently. It's a much bigger beast. It's slower moving. You just have to zoom out on a chart and you can see how different the last year was. So I expect that this is kind of the bear market vibe that we're in now, but it may not get that low. I think personally we're already in a sort of a value type spot. Doesn't mean that we're at the bottom, but if I put it on a scale of 0 to 10, for example, 0 being generational bottom and 10 being some kind of pico top, I think we're probably around a 3 or a 4. So, good value opportunity, but doesn't mean we can't go lower. And my reference to that is I haven't seen, in terms of the potential depths that we could go, Bitcoin tends to shock and surprise people, both to the upside and the downside. And I haven't seen a flush out of a number of metrics to the downside yet. We may not get them just because the market's more efficient, just as we didn't get a number, to the same level of upside that I would have expected last cycle. But yeah, any kind of shock event could drive us down there. And what I'm talking about is kind of the 20s to 30Ks would be the zero rating as I'm talking about. So the absolute sort of greatest opportunity in my mind. I'd be very excited to go max long, so to speak. Personally, that is. But that said, where we are now, a 3 or a 4, I think that's a great value opportunity. I think on a 1 or 2 or 3 year horizon, that's probably going to do very well. I think it'll probably be much higher. But yeah, there's definitely I can't. It's easier to call when there's a more clear extreme. We're kind of in a lower opportunity area, but it's definitely on the more value side, I'd say.
Yeah, I'm totally agree on that because as you mentioned before, MVRV reached about 175, which means the average PNL for all wallets on the blockchain is just 75%. So we might not hit the cyclic bottom if you see the historical pattern, but the majority of Bitcoin holders, like miners and Bitcoin holders who have Bitcoins for like over 7 years, and institutional investors who joined the last year, they didn't move any Bitcoins so far, I think. We've been tracking those wallets. So I think newbie who joined last year, they're holding their Bitcoins and then, so to speak, evolving to long-term holders. So it's really hard to get, it's really hard to see 20K, below 20K, because they are not going to sell their Bitcoins for those newbies.
Yeah, I agree. I kind of, there's always never say never. There's always the off, event we can't foresee now that could drive it. But with the data we have available today, I just do not see anything below 20K happening. And you're right. The supply side looks really strong. That's probably one of the better metrics today. Continued outflow of supply from exchanges and into larger wallets and that sort of thing. But yeah, it's the demand side which has been a bit lacking, obviously, and the demand side which has probably been more tied to the TradFi markets recently, and just correlating to the downside, I suppose.
Thank you for sharing your views, Charles. Now our CQ verified authors will be asking questions that most of us are curious about: miners and hash rate. Let's start with Spirit Chomber Kim, on-chain analyst from Korea. She'll be asking you questions regarding your models that you have created.
Sounds good.
Yes. What's your take on the hash ribbon in this cycle? While the hash ribbon did not back the market direction and it was indicating bullish signals, the price dropped massively. Even in this case, do you think the hash ribbon indicator can still be significant? If not, how can it be supplemented?
Yeah, good question. I think I still think it's valuable. I think every signal since that indicator has gone live has been profitable, at least in the short term, and usually very profitable. So personally, I think it's one of the better buy signals out there still. That said, it was never meant. It never had a sell signal associated with it or an exit signal, right? And that was because it was even with other metrics too, I find it's much easier to get a better reading when you're in a deep, extreme undervalue opportunity to buy and hold for the long term. It's trickier to find an equivalent opportunity to sell or exit. And that's because even if you just think about simple dynamics of taking a long versus the short, the short, if you sell something at $100 and you expect it to go down, your maximum return is 100%. If you buy something at $100, it can go up 10x, 20x, unlimited, right? So Bitcoin has often, at least historically, gone up in multiples and to extremes, so it can be harder to time the top side. That doesn't mean there aren't metrics which are useful for managing that risk, but at least with hash rate and hash ribbons, I never and still haven't been able to find something which is useful for timing downsides. So that's worth bearing in mind, that if you're using it as a buy signal, you have to understand that there will be periods of downside. Usually that is after a good period of positive return, but that's kind of up to you to manage. And it goes to the point that there's no one metric or signal which can be used to outperform indefinitely everything. You have to use a portfolio or a confluence of signals to manage your market risk and exposure. So that's how I'd disclaimer that. And if you look at it over a weekly or monthly or even multi-monthly horizon, all those signals have been pretty profitable. But that said, I do, and I intend to continue using them because of that. And until that hit rate stops, I will keep using it. But I do think, and this is speculation, but I do think that in 2, 3, 4 years from now, the current signals probably will either have very little return opportunity or will potentially have no value. I can't say when and how that will happen, but I think that it's a factor of, firstly, the diminished impact of miners on the network. A couple of years ago, miners were the biggest players in crypto, and then you had pretty much just retail traders, and there was only those two entities, more or less. Today, it's, miners are a small element of the pie of ETFs, funds, countries, banks, etc., all trading with much more sophisticated information. And historically, miners were just trying to manage their cash flows. They weren't trying to, necessarily trade to the optimal. Whereas now, the market is very different. It's much more efficient, and the miners are smaller players. They also have less supply impact into the future with each halving. Obviously, that their supply inflow halves into the future. So the impact of a miner capitulation, I think, will diminish with time. I don't think it's going to go away because it's a nature of reflexivity as well. If a mine is capitulating, it usually means price is low, probably means other things are happening. Maybe it means there's a macro or a TradFi collapse has happened. So I still think that the hash rate signal will be useful. I just think that the impact will probably reduce with time. The other element of that is, I think, any signal which offers alpha and has a track record of that, like hash ribbons, will be, it gains more usage, it gains more eyeballs looking at it, and then ultimately with time, I think I can imagine people could counter trade that, because if you're looking to unload a massive position and then that there's 100,000 people trying to buy a hash ribbon signal, it makes sense that you might use that timing to manage your liquidity. So I don't think we're at that point now, but it could happen, right? So there's a number of elements which feed into alpha decay of any signal with time. Like I said, I don't see that yet in hash ribbons. I still use it and intend to use it, but I do expect there will be a lifespan of it, at least in its current format. So there may be a variation of it, more refined, granular, calculation of hash ribbons, which yields alpha in, even longer into the future if that were to happen. But for now, I think the current version is sound and probably will be for a good couple of years, but diminishes, with time, obviously.
Thank you for your answer. Then do you think the timing of miners taking the lead will come back?
Say again, sorry. Do I think the miners?
Yeah, the timing of miners taking the lead will come back. Do you think?
No, as in like having a sort of market control and dominance, and I don't think so, because because of the halving, right? They're every 4 years, and even now the inflation rate of Bitcoin is around gold, and in 4 years it'll be less, and it'll be the hardest asset ever, and that just means less inflow of Bitcoins, of quantity to the miners to distribute. Look, there's probably some large mining entities who have been around for the long term who will probably adapt their strategy. Maybe they'll become investment businesses, maybe they'll become some kind of fund or something, or ETF or what have you. And there's always going to be edge cases, I suppose, where that control will be maintained. But I think largely over the next 4-8 years, we're going to see more and more countries adopt Bitcoin. We're going to see it on more and more S&P 500 balance sheets. And the holdings that those type of entities have will be so large that it will just dwarf the impact and power of at least the majority of miners. And all of that kind of leads into Bitcoin having more and more of a relationship with the TradFi markets into the future, I think.
Mm-hmm. Great. Yeah. The second question, can you briefly cover your Bitcoin production cost indicator? Given the current conditions in the market and price funding support multiple times since 2021 on your indicator, do you expect your indicator to firmly set the floor on BTC around 33.7K if tested?
Yeah, so okay, I'll step through all those. So yeah, Bitcoin production cost was an indicator, and I wrote an article about it a couple of years ago. It was basically me trying to estimate, how much does it cost to produce one Bitcoin, and theorizing that would act as some kind of either price floor or at least an area of opportunity if the price of Bitcoin were to reach the price that it costs to create one Bitcoin. So I used some data from Cambridge CBCI on mining hardware and hash rate data, and basically we know that the hash rate of Bitcoin, so we know the energy used to create a Bitcoin. We know the Bitcoin inflation rate, it's fixed by block and what will be produced. So we know the energy going in, we know the quantity of Bitcoin coming out. The only question mark is, okay, so the hash rate just represents the energy that was finally used to mine, but there's more energy that goes into Bitcoin and is lost in heat and other inefficiencies in hardware. So that might sound insignificant is a very big impact. So hardware efficiency of Bitcoin rigs has gone up, like, I don't have the number in front of me, but something like 10,000 times in the last 10 years. And there was a huge step change 3 or 4 years ago, which massively increased the efficiency. So with time, the rate of energy going in is closer to 1-to-1 of what is used to mine Bitcoin. So anyway, that gives you the energy going in, and then you can do a number of surveys or get information on the market on what the average electrical price is globally. And effectively, you just multiply that all out, energy in, cost in, and quantity of Bitcoin produced, and then you get a price per Bitcoin. And there's obviously some assumptions in that. I had also, based on some surveys and other sort of traditional finance measures of operations costs, had to estimate, that's just the electrical side, but what is the cost of running a business in mining? There's admin costs, there's building costs, rent costs, hardware costs, depreciation, all that kind of stuff. So came up with a factor to allow for that, and that at the moment is about 40% more than price, give or take. And what you get is, when you add all that together, is the production cost. At the moment, it's around 35K, up or plus or minus a few K, depending on how some of these assumptions you make. And then the electrical cost is at the moment around 22K, I believe. And that electrical cost is basically just only considering electricity. So if the price of Bitcoin goes to electrical cost, it faces a miner with the question, do I want to keep the electricity flowing to these mining rigs to mine Bitcoin, because my electricity bill is now the same as the Bitcoin revenue I'm receiving effectively. Now, there's, in reality, if they've got a long-term view, or if they think the price of Bitcoin will probably rise, et cetera, they may continue to operate at a loss in the short term, as many businesses do. It's just that historically, at least for Bitcoin, every time it's touched the electrical cost, which is only 2 or 3 times in history, it's been like the generational bottom opportunity. So that's in kind of the low to mid 20s at the moment, which is why, as I was saying earlier, I just don't see us going below 20K pending a bigger meltdown. And these numbers can change, right? Like they change with the number of hash rate going into the network. So if we do get a big drop in that would change. If a country like the US or someone banned Bitcoin mining, of course, all of these numbers will change. But given the data today, they're the price levels it's at. So the other thing I did a tweet yesterday I was thinking about is just the impact of inflation now is so significant. If you just look at a chart of the M2 money supply and just draw, parallel lines to that curve, you can just see that it's just ratcheted up every 5 to 10 years. The rate of money printing has just continued to increase for like 30 years, basically. And at the moment, the annualized increase in M2 is about 13.1%. So, for the 10 years before Corona, it was about 5-6%. So that's a massive kind of leveraging factor. We're obviously seeing that now in CPI and gas prices, everything, and obviously war is not helping. So I think there's a valid case to potentially ratchet up the cost factors of electrical cost. But that's it's early days. That's a judgment call from anyone using that. And if you do that, the production cost is more around 37K, and the electrical cost kind of mid 20s or in that region. So that's why I kind of think that any Bitcoin price, given today's data at least, between 25, 35K is like a fantastic opportunity. And it just, obviously that value opportunity increases the closer you get to it.
Yeah. Thank you for your detailed cost view. The last question. From long-term investors' point of view, would it make more sense to outright buy BTC or mine BTC given the current conditions and prices?
Yeah, that's a tough one. I think it's definitely case by case. It depends on the opportunities you can find. Historically, in more of the China mining eras, the average electrical cost globally per kilowatt hour was around 4.5 cents. It got more efficient into the later years, but then obviously with China turning off, the average global prices have gone up, and that figure is changing all the time. You now have El Salvador with volcano mining, and you have talk of other major power producing companies using their excess, gas or what have you, to mine Bitcoin. So their bill or their electrical bill will more or less be zero or very close to it. So if you're going into mining, I think you have to have that long-term mindset of what's the arrangement I'm setting up? Is it going to be cost effective into the next 5 years? Because the numbers I've looked at a high level, and I'm by no means an expert in this area, but from what I've looked at, you pay back where things start to get interesting is 2-3+ years of running these operations, and you could well be profitable if price stays above these kind of levels, but your risk obviously increases the lower price goes. So your margins will compress with lower prices. It can be less effective in bear markets. It also usually, if there's a huge price run up, such as in late 2020, early 2021, mining often is less effective than buy and hold. So you have to do an analysis case by case and the opportunity that's presented to you. I think there's definitely some great opportunities out there, but you just got to consider all those factors. So it's very hard to make it just a general call of if it's a good idea or not, because there's so many different opportunities around the world today and different price cost arrangements as well.
Yeah. Thank you for your answer. Yeah, it's the end from my side.
No problem. Thank you.
And we'll have a follow-up of Crypto Bizarre asking his his question that everyone wanted to ask you regarding your view on chain data. So let's have Crypto Vizard here.
Hello, everyone. Hello, Charles.
Hey there. How's it going?
Oh, it's a great pleasure to be here. Well, I cannot just because you mentioned the hash rate is a great indication when the worst of miners is over, and I cannot agree more. Especially the part that you said it's not giving you a signal for exiting the market, but entering. It was really, really great point, and I cannot agree more. But I want you to, because you're focusing on the mining part, if you want to lay out or give a template for on-chain analysts or any researcher in this market to how to follow the miners' behavior, given the fact that they're mostly changing their identity from small miners to entity-based miners, it's becoming a really, really big industry. But how, if you want to give two or three indicator or on-chain metrics or any other indicator that you think is worth to mention to the analysts to use to follow and study the behavior of miners, what would those be? Like, what do you think is the top list of a miner researcher?
Yeah, that's a tough one. I think this is a whole industry now. Mining is huge and complex, and it's not a huge focus or attention of my time on an ongoing basis. So there's probably people better informed on this and monitoring different data by country and company. But for me, I just pay most attention to what I think are the more generalized metrics of the market and data, which I think have high hit rates over time. And that by nature means ignoring 95, 99% of other on-chain or technical or whatever metrics, because I find that most of them, if they don't offer a consistent hit rate or information, are not valuable, and they can be damaging, I suppose. So with this, I tend to keep it quite simple with mining and just look at primarily hash rate. I think that's a great measure of a number of things, of network security, of growth, of adoption. If hash rate's going up, more miners are committing to the network in the long term. If hash rate's going up, the energy value is going up, the production cost is going up, the electrical price is going up. It's just a healthy measure of adoption from the supply side. It also gives you information from a reflexivity to the demand side, because if miners foresee the future of Bitcoin as bleak or as another altcoin or as something else is better, they will obviously shift their hash power and energy potential to another network or to another business and move out of Bitcoin. So it gives you a lot of information in that simple number. And it summarizes the global market pretty precisely. So you'll see a lot of case by case situations of maybe a business going bankrupt or people opposing a certain enterprise because of geopolitical or environmental issues, or a particular country might shut it down, and that will generate a lot of noise on Twitter, and people maybe a lot of predictions. But often you just look at a simple metric like global hash rate and it will tell you pretty quickly whether or not that's significant or not. So that's something I like to look at. The other point is, obviously, it updates daily, but there can be wide fluctuations intraday. So I tend to look at the trend of that over time. But that said, people often also discount that when you get a really, really high hash rate, a really, really low one, people often say, it's just one data point, doesn't mean anything. It was only one point in time. That's true, but it also means that at that point in time, there was that level of extremity. So I don't necessarily action every data point, but if you get a really high spike, it tells you that there's something positive going on. And obviously you want reinforcement with that through time and consistency of hash rate going up, which you can use to monitor it. So that's kind of my high level look at it. And that's more or less as far as I go, but as well as using those other indicators, because that's the information that I need for my purpose of trying to identify value and opportunity in the space. But yeah, there's plenty of good research is out there. Cambridge is one, and other studies of the mining space, which will give you a lot more detailed info and granular info on this stuff as well.
Wonderful. And there's another question, I think, because you said you're not really focusing on the on-chain and data related to the miners, but I think my next question is, there's no answer to that, but I want you to have your personal idea about this. There are lots of controversy about the motivation of the miners to stay in the business, because, like you said, it is converging to one. The cost of mining is getting closer and closer to the price in the market, at least at the bottom in the bear market. What do you think is going to motivate the miners to stay in the business in long term? I'm not talking about the big entities, because obviously they might have their hand over a really cheap electricity and they have the motivation to stay in the business. But what about the small miners? Like it could be like a private miner having one miner, or an investor that investing in the mining business by buying a stock and in any way that they can. What do you think in long term? By long term, I mean in next decade. What's going to motivate the miners, knowing the fact that the revenue that is coming from the block rewards is getting half every 4 years? I know there is no correct answer there, but I'm sure you have an opinion there. I'm really interested to know what's your idea there.
Yeah, sure. It's hard to predict that kind of thing. So just a speculative opinion, of course. But I think market forces will just dictate the supply and demand quite efficiently, as they have. If you just look back to the last 10 years, when Bitcoin started, people were just mining Bitcoin in significant quantities on their laptop at home. Now you couldn't do that because you're just going to, destroy your electricity bill and not get much out of it. So it just becomes more efficient with time. And to that example I gave before, I think the future is probably going to be much more industrial and efficient, with, probably countries and large power companies driving the bulk of mining into the future. So, if you've got a hydroelectric dam, or if you've got, a gas or an oil field in the middle of the desert or something, and at certain periods of night or other times of day, you've got 5 or 10% power output, which is doing nothing. Even if your profit margins are thin in this hypothetically really efficient Bitcoin future world, it makes sense to mine that, because it otherwise you're just wasting that electricity. You can use it to generate some Bitcoin and increase your profit margins. So I think the trend does go close to zero, but as with all things, it never reaches it. And I think it just gets more and more industrialized and competitive. And it will probably line up with country adoption quite well. Like El Salvador is probably the perfect case example of what the next 10 years will look like. Adoption as a tender or on the balance sheet. And then likewise, once you do that, you're like, well, how can I get control of this asset and generate more of it for myself? And they're doing it super efficiently with volcano mining. So endless energy supply, more or less. So I think we'll see the same thing in major developed countries and global power companies throughout the world. And there may be instances where it makes sense for a power company just to switch to mining Bitcoin, because their infrastructure costs of sending that electricity or that gas or shipping it internationally, all that kind of stuff, there's probably cases where it makes sense for them just to do mining. So I think that's the direction it goes for probably the coming decade. From there, it's hard. Who knows? At some point, decades out, 50, 100 years out, obviously the block reward basically approaches zero, and we're dependent on fees generating that, and that will obviously require mass global, more or less, adoption of Bitcoin to justify the income from it. So I think, again, market forces will dictate how that goes. But I think so far, it's reasonably healthy, on track in that regard.
Thank you. I'll be picking up the questions from here. So
Sorry, I think I was mute. Hochan, can I ask one last request from Charles? Charles, can you like retweet your? Because I was looking for an article that on that production model. I'm really interested to translate it to my community. I want you, if you don't mind, just retweet it today, because I'm sure many people have question now. That 35,000 is really looking realistic. So I want to like lay it out for my followers in other languages as well. So I would appreciate if you could retweet it, and I'll try to translate it and pass the word around.
No problem, will do.
Crypto Wizard, you can ask Charles regarding your questions. I picked up because I thought you had a network issue.
Oh, perfect. No, I thought like you're gonna bring some people up to stage and ask some question. If we want, we can go there. Before we asking Charles the favorite question, what is your like top metric that you're using from CryptoQuant? You can let Charles answer that question. What metric is his favorite in CQ?
Yeah, that's actually the first question that I was going to ask for Charles as a as a lightning one. Is there any favorite metrics in our service?
Yeah, sure. I think there's a few, and it also changes with time based on what I think gives the most useful information to me at that time. Exchange reserves is one which I pay a lot of attention to. I think the overall macro trend of that is extremely bullish, net down, which means that there's outflow of liquid coins from exchanges, which means that people are probably on net tying it up into savings or other asset vehicles. But as I wrote about in that January update on our newsletter, I think some of those metrics like that also are a lot more noisy today. They have a little bit less signal in them because there's so much more happening in that data than used to be. So if you go back a couple of years, Bitcoin was either on exchange or in cold storage, and there was more or less no in between. And if it was on exchange, it was a BTC trading pair and nothing else. Whereas today, it could be so many things. It can be in a custody for a fund or an ETF, which means they can trade it, sell it. They could short Bitcoin even while their inflows are going up because they've got credit lines. It could be, sold into USDT, and that could be lent out. There's so many different applications now that the flow and the meaning of a flow has a lot more information in it, which means that it can be harder to discern from an aggregate level, at least for a metric like that, what is necessarily happening. Another example of that is just funding rate, right? That used to be a great indication of speculation of retail traders in the market. But now you have a lot of institutions just arbing that to get delta neutral positions and generate a rate of return of, say 5, 10, 20% a year, relatively risk-free. So, and all of that means that the signal in that data is a bit diminished. But that said, with something like exchange reserves, I think any kind of major short-term movement is worth paying attention to. You often do see, if you zoom in on the hourly or block level on CQ, if you see like a 1% or a 2% spike in exchange reserves, you'll often see that the next, 24 hours or several days after that, the price of Bitcoin might tend to decline because probably someone is unloading. That's a generalization, but it tends to be a good risk metric to look at. So I like to look at that one. Other one is obviously open interest and funding rate. There's some good variations and metrics you guys have of things like open interest with RSI that your community creates and tweets about, which are quite interesting and help identify sort of risky levels. And key one of your metrics, I think, the exchange whale ratio is also pretty good. I think that's pretty good at, like, as you identify when it goes above 0.5, it can often mean that, particularly if you're at the highs, that there's a dump coming, at least in the short term. So all these metrics are useful on different time horizons. Something like that one, I'd be keen to hear your thoughts, but I think exchange whale ratio is probably really good if you're looking at taking a position, for hours or maybe a day or two. But beyond that, it's because it spikes around a lot, it can be mostly noise. So it depends on your time horizon. In my opinion, a lot of on-chain metrics are useful or mostly useful, offer the most value at extremities. Extremities being extreme highs or lows in those readings. And usually when you get those readings, it's months before you get the opposite reading. So by the nature of that, what that means is that these data points or on-chain analytics, for me, is more useful over a multi-month horizon of if you've got relative value or undervalue and how to position yourself. But I think there's other levels to that. There's other professions to that of micro-analyzing this stuff and creating strategies which trade, again, like the whale ratio on the low time frame or tracking particular, I know a number of traders who track specific wallets of other traders or institutions and use that to drive short-term strategies. So yeah, there's opportunity out there, depending on how you slice and dice that data. It just depends on your time horizon and your philosophy. But those four metrics, whale ratio, open interest, funding, and exchange reserve are probably my most interesting ones at the moment, because I feel like they have probably the most consistency of a lot of those metrics out there anyway.
Thank you for liking our data. I hope everyone uses it well. The second question might be a little tough one. There's a different trend in crypto, like the rise of DeFi in 2 years ago, and last year it seemed like an NFT, and now it seems like a DAO. Well, how this trend change will affect the dynamics of layer one chains in your perspective, and also other like how it will fluctuate the mining industry as well.
Yeah, I think they're powerful trends. I've been saying for a couple of years now that I think DAOs are an extremely efficient business model for certain applications. What we've seen in DeFi in the last year, 2 years, and the rate of innovation and growth and the actual use case of products is incredible. Nothing. We'd never seen that kind of stuff before 3 or 4 years ago. Now you have genuine businesses with billions in assets locked in TVL, different applications, which is an incredible innovation. I think it's here to stay, and they can operate far more efficiently in many cases than a traditional bank or in their specific use case. For example, options, DeFi option pools, or stablecoin lending, all sorts of things. It offers great efficiencies, and then DAOs in particular. The Constitution DAO was quite interesting, what happened last year. So the idea of pooling together a lot of people very efficiently, very quickly, in just a couple of days' time to try and bid for a multi-million-dollar, Constitution. Obviously, they weren't successful, but they raised something like 30 or 40 million from memory. It might have been more in a very short period of time. And that just shows the power of, it's basically crowdfunding, but far more efficiently and, with ownership fully verifiable. So I think that trend is here to stay. And like everything crypto, it will go through cycles and waves. NFTs is a good example, as you mentioned. It's obviously had a huge bull run in the last year, which looks like it could have at least locally topped in the last month, with all this negativity in the sort of macro space. And that it could, I don't have any exposure to NFTs at the moment. I have had in the past, but not at the moment. And I could see it going a number of ways in the short term. It could go down quite a lot. But I think the Pandora's box in terms of art and ownership digitally has been opened, and I think that will offer a huge trend of art and business into the future. So all of those areas I think are quite exciting, and it's not like it was in 2017-18 where you just had a white paper and a dream. These are actual usable applications. So I think that's pretty cool. And in terms of L1s, I think obviously they're running on L1s, and the biggest one obviously being Ethereum. So it just means more capital flowing through Ethereum, more assets locked in Ethereum, and that increases the value of the Ethereum network. And we've kind of seen that in the last year and a half, just by how much Ethereum, particularly in 2021, outperformed Bitcoin. So if they can maintain that, obviously they've got a number of challenges which will hopefully be resolved with ETH2 and a number of other improvements. But their transaction costs, they've got potential supply challenges and how their model is built, etc. So they've got competition, but in terms of the whole industry and how DeFi, DAO, NFTs, Gamefi, etc., is growing, I think the opportunity in that space is huge.
Thank you. I think, as you have mentioned earlier, I think it also would impact the miners, how they would turn off the Bitcoin mining and then start other mining as well, right?
Yeah, it just comes down to opportunity cost, I guess. I think with mining, it's a bit different because your hardware is kind of linked to the type of algorithm you're mining. So it's not necessarily easy to just switch from one network to another. There are certain, like Litecoin, Bitcoin, Cash, etc. It's easy to switch. For others, maybe not as easy to be as competitive in, but it comes down to long-term opportunity cost and where you see the value of business. If like I said, if you're a power company or a country with significant government assets in the power space, then I think just mining Bitcoin is going to be a no-brainer. But if you're another commercial enterprise, there may be better opportunities for you in these other areas as time goes by.
Thank you. Thank you. Well, thank you for sharing your feedbacks. Is it okay if we take additional questions from like a couple of listeners who are listening to our Twitter space?
Sure, let's do it.
So anyone who's listening to this, if you'd like to ask questions, now's the time. Please request speaker to me. If Charles thinks the question is good enough, we'll give you 39 credit. That is equal to 1 month of advanced plan in CryptoQuant. So here's a chance.
No pressure.
Yeah, I think it's a midnight in like US time zone and late night in Korea time zone, so everyone's might be a little bit shy and low at the moment. If there's none, then we'll close the session.
Ochan, I got a question from a friend I can ask on behalf of him.
Yeah, sure.
Yeah, like there was this, of course, it's just so futuristic and you might be 100% wrong, but there was this theory going around in a conversation that interested me, that they were claiming that maybe the motivation of the miners in the future is not going to be profit. Like, let's say you're a big entity, you have a big chunk of Bitcoin in your position or on behalf of your investors. Instead of looking at profit and motivate yourself to invest in mining, you're simply looking at as paying for security. Like, let's say you have a chunk of like 2 tons of gold. You have to pay for security. You have to pay for a vault to hold on to it. And investing in mining is investing in the security of your property, which is Bitcoin now. What do you think? Is it going to be like a valid theory in the future that simply securing your Bitcoin is motivating you as a government, maybe, or maybe a grayscale in future, simply make you to pay for mining and keep the system going on? Do you think it's a valid theory or no? It's totally off.
I think to a very limited extent. I think maybe for countries, right? Like if a country acquires a large percentage of Bitcoin, kind of like gold today, most of the major developed countries have pretty large stashes of gold. If it gets to that point with Bitcoin, which I think is the end game, where they have large quantities of it, there may be valid, and if their economy does well using Bitcoin, there's a valid case for them to try and secure that. But generally speaking, businesses and people are profit seeking, and they're going to have opportunity costs. It doesn't probably make sense for someone to dedicate all of their time and energy into something which is, at least apparently loss making, if they've got a better opportunity out there. And that kind of just plays into capitalism in general, right? And how capitalism has dominated everything globally, except for, you have the odd, NGOs and voluntary businesses out there, but they are the edge case, right? So I don't think they will, if Bitcoin's dependent on that kind of outcome of voluntary service, which is non-profitable, I think there's a bigger problem for Bitcoin at that point.
Wonderful. And one last question that I just got. And there are lots of debate on this centralization and decentralization. And I think this is a valid question, or at least downside with Bitcoin, that after China ban, or even before then, decentralization in mining was a big question mark on Bitcoin. And we cannot deny that now by moving to North America, it's probably, and I think it's true, that big companies and probably governments are going to be the main miners there. And it means more centralization. But recently Jack Dorsey talked about like a decentralized kind of scenario, like they're trying to, I don't know how, but they're trying to come up with a way to make it more decentralized. Do you have any like information or just some picture what's going to happen? What will be the possible scenario to get away from this centralization that is happening in the mining industry? Do you have any like picture, or just it could be obviously a speculative, that's fine, but what do you think?
Yeah, probably nothing of great insight, but this was also a big concern 3 or 4 or 5 years ago when we had the emergence of these Bitcoin pools and aggregation of hash rate. But it's still more or less remained fairly well distributed globally. And I think, country game theory such as El Salvador is just going to play into that. I think it's a fair assumption to say El Salvador did relatively no mining, a couple of years ago, and now they're, trying to get competitive in that space. So I think as more countries enter the game, that will add to the diversification. The risk probably you have of that is individual major powers, so China, Russia, United States, maybe Germany or some other major developed countries, if they go in really hard and just absolutely dominate hash rate, then that could be a risk in the near term. But I think once that happens, you'll see a similar reaction from other countries, such that it will just continue to diversify. So yeah, it remains to be seen. It'll all depend on the market efficiencies of mining Bitcoin and how the geography of that is set up into the future. But at the moment, I think it's still pretty well diversified or distributed.
Wonderful. Wonderful. Thank you again for your time. And I'm done, Ho-Chan.
My pleasure.
We also have a guest speaker. I like his name, Number Go Up Technology. Is it okay if I take a question from him?
Yeah, sure thing. Let's go.
You're on Number Go Up Technology. You're unmuted.
Cheers. Thanks, Charles. I just wanted to make a bit of a comment and then get your thoughts. So when you overlay the M2 money supply over the Bitcoin chart, the highs in 2017 reached the same level as the lows that we had in October. So I'm interested to know what your thoughts on the expansion of the money supply in the US and how that will affect the price of Bitcoin in the future, seeing as there might be no way for the US to escape further money printing.
Yeah, good one. I think it's definitely ratcheting up pretty much everything you look at in the asset space. And in terms of Bitcoin, I now think of it as ratcheting up just general Bitcoin metrics as well. As I noted earlier, with the production costs, I just added an option to put a factor on there for this new massive increase in the increasing supply of M2. So it makes things harder in a way in terms of analyzing different markets because you now have this huge factor which it's hard to know how it will change into the future. Obviously, we can make assumptions that they're going to maybe tighten for a year or two. Maybe they won't be able to do that for long, and then they'll have to do more QE. But it's this huge volatility, effectively expansion factor, which is applied to all this data and metrics. I think long term, it's only good for Bitcoin. I think it's the death knell for fiat and the dollar. The more they keep increasing this inflation rate in the long run, it's just how does it? The only examples we have from before all of our lives in the 1930s and 1940s type eras, and you look at how how reserve currencies changed and war and tensions and populism and all these kind of things that are playing together we have at the moment. And it's not easy to pick the winning asset. There's a lot of volatility, a number of countries which looked really promising, like in the like Germany's economy looked really promising in the 20s and that kind of area. And there are a number of other examples like that where they just completely blew up effectively. So it's hard to project how it will all play out. And even the stock market is a bit of a mixed bag in these kind of rapidly expanding times, and in terms of big swings to the upside, but also volatility to the downside. So in somewhat uncharted territories or in territories with at least limited data, I think it's, narrative-wise, it's perfect for Bitcoin. If you're a long-term holder, it's going to, only help you, I think. In the short term, it can make things more challenging. Hopefully that answers the question.
Cheers. Thanks for that, Charles.
We'll collect the last question from Coin Info, and Charles will be not taking the answer. What should we give the 39 credit to number go up? Was the question good enough, Charles?
Yeah, definitely. Let's do it.
Oh, got it. Okay, let's take over to Coin Info.
Hey Charles, I noticed that you're on CryptoQuant that makes algo trading a part of it. And you also mentioned that there could be a possibility of all the metrics becoming less efficient for the crypto because all the people are seeing it, right? So then would your fund be affected too? Or do you think that new and other efficient metric would appear? Also, what would be the biggest difference between running traditional algo trading fund versus crypto algo trade?
Yeah, good question. We've definitely been affected. So in the last year, we saw a number of our more profitable strategies, just their hit rates, which were very high in the past and did well for 1-2 years, just either stopped working or reduced massively in their success rate. So we had to reshuffle and rebuild a number of things last year, and we're it's a continual process of keeping up and adapting to markets as they develop, and that's always been the case. It's just that there was a big step change with the institutional adoption last year. That said, I think there's definitely long-term opportunity there. You just have to look at a number of the funds and entities in the traditional finance space which have been successful in the long run. Obviously, it's not easy to do, but it's definitely possible. And there's always data and insights and models that are available which potentially other people aren't looking at. I think for Bitcoin and crypto, it doesn't mean that nothing works anymore or that all the old metrics don't work. It's just you just have to keep a careful eye on what you see as important. You'll find on Twitter, people will find a metric or a relationship to data, and they'll highlight it and show how good it was at timing a top and a bottom, and they'll just tweet about it, and then everyone will retweet it. And in reality, if you open that metric and you zoom out, maybe it got 2 or 3 perfect tops or bottoms, but that was it. Or maybe there was, less than 5 or 10 data points, so it's possibly overfitted, or maybe it's got this really complex calculation in the back, such as stock to flow, which has been changed 10 times in the last year. So what I'm trying to say is most of the stuff you see circulating Twitter, you should be cautious of, or at least do a lot of due diligence in if you want to action it, because most stuff is noise, really. And that's, there's some of the basic raw old school metrics I think offer a lot of value still, such as NVT. So there's kind of the P ratio for Bitcoin. To date, it's performed very well, even in the last year and a half, in terms of identifying risky regions and undervalued regions, such as we've been in recently. So there's definitely opportunity there. It's just a changing game, and you have to adapt to newer models, and then you have to weight more recent data more heavily. That's performed in more recent times as well.
Thanks, Charles.
My pleasure.
Thank you. Was CoinInfo's question good enough?
I think so. What do you think, Kay?
I think so. So, CoinInfo and number go up. Please DM us after this call's over. We'll DM us your username and user email of our site. Then we'll give you 39 credits. I think we'll have to close the show today. Thank you for your precious insights, knowledge, and time you shared with us, Charles, Key, CryptoVizar, and Spiritual Book Kim.
Thanks for having me, guys. It was really good to chat. My pleasure, and always happy to jump on another time.
Glad. We'll also collect our user questions and then share with us. If you're okay, we'll make it sometime after today's Twitter space. Is that okay? Cool. The discussion that we shared today will be summarized and uploaded on CryptoQuant's Quick Take, also being shared in Twitter, and the full live version would be available on our YouTube channels. So thank you for listening to today's call, and thank you for sharing your time, Charles.
Thanks, guys. Have a great rest of the day.
Thank you so much for joining us.
Thank you, everyone. Thank you, Charles,
Bye-bye.
and all audiences here.
Thank you, Charles.
Thanks, guys. Bye.